Good morning, everybody. This is Eureka John with Eureka Street Crypto Hub, broadcasting live from Leander, Texas. And it is July 25th, 2021. It is a Sunday. This is episode 215. It's not including some other just random episodes when I was first starting out trying to gain my footing. But either way, I'm just considering it episode 215. I've been broadcasting live since October 24th, 2020. And I've been doing this every single morning consecutively without skipping a beat since February 6th, 2021. And this is what I do. It's my morning routine. This is my video blog, my crypto show, me just talking about crypto news and stuff and trying to figure out concepts along with you. I'm definitely not a professional and I'm not a teacher. I'm depending on your input as much as me in my own research and trying to figure out what a lot of this stuff is. And I'm figuring out as I go along with you. So it's kind of the beauty of the show. My focus on imperfection and yes, and personal growth. And all right. Good morning, Randy. How you doing? Thanks for jumping on again. So let's see here. I was talking last night with a friend. We were at their house having dinner, and we started talking about crypto. I normally try not to bring up crypto with friends and family because then it just turns into a one-sided conversation where they start to glaze over, and I'm enthusiastically just like ranting and raving and waving my hands in the air about the fourth industrial revolution and cryptocurrencies versus central bank digital currencies, dystopia versus freedom. And then my wife is over there like nudging at me being like, babe. So that's why I do this show. It gets it out in a lot of ways before I go about my merry way in my day. So it did bring to light some things that I was kind of having a difficult time trying to describe. And one of those was, what is the difference between a token and a coin? So, token and coin. And then I noticed in my Atomic wallet, the way that they divided them out was between tokens and coins. And I was just like, I never really thought about that. I know, token versus coin. Okay. You just always think, I know that there's the commodity versus security thing, that's going on, but I never really thought about like token versus coin. Good morning, Effect Chen. How you doing? Okay, so first of all, let's take a quick look at the old CoinGecko and see what we got going on here. I know things have been getting a little bit greener lately, which is just fine. But price is not necessarily what a lot of creators are really focused on these days. So you can follow everyday day-to-day price if you want to have a massive coronary aneurysm every single day. And I don't have the patience or the stress level tolerance or anything like that to deal with trading and day-to-day type of stuff. I know some people are really good at that and they thrive off of it, but to me, being a really good trader in the crypto market is like becoming a professional musician or baseball player or something. There are millions of people out there doing it. There's only a few that are really good at it. So if you find, I believe with anything, if you study and research, you can get a good grasp on just about anything and become good at it and enjoy doing it, which is what I do with a lot of things. I'm kind of the jackass of all trades and a lot of stuff, because I enjoy learning and that process of learning and acquiring a new skill. However, to be truly good at something, there is this inherent, ingrained, natural ability, artistry to it that somebody can just possess, like a gift. And some people excel in that way, and of course everybody has to put in work. I mean, it's a given. But there's just some people that when they specifically focus on something right where their gift is, then they will particularly excel at that. And day trading is not my particular forte. So that was the whole point of me going off on that little weird motivational, semi-motivational spiel. So anyway, so let's take a look at CoinGecko. $34,413.03. And Ethereum back up at 2164.70. I didn't really have any money to buy any more Ethereum. Luckily, I'm mining it out of my computer, so I got a little bit of Ethereum from that at the low levels. But it's I did shuffle some things around and sold some of my totally garbage coins, but I didn't really want to sell anything at the bottom. I don't know. I just wish I could have gotten in on that when it was down at 1,700 for a little blip there, but I didn't. But some of you, I'm sure, took full advantage of it. As the rest of the world is cringing at the crypto space, I'm sitting here just cringing at the fact that I can't get what I want at that moment. I did end up getting some Matic tokens at a pretty cheap price. So yeah, Cardano $1.22, XRP 60 cents. So we have 1, 2, 3 stable coins in the top 10, which is pretty interesting to me. It shows a lot of people are coming into the crypto space to me and using these stable coins to gather interest on them in a way that you can't do with banks, but they're still being pegged to the dollar, so they don't feel like they have to necessarily be exposed to the volatility of the rest of the crypto market. And also, stable coins are used, and I've said this a few times before for you people who have seen several of my episodes. The stable coins are also is the place where people can sit on the sidelines for a while. It's Adult Swim. Allow the stable coins to jump in the pool for a while people take a break from the erratic crypto price trading and stuff like that. And so the lifeguard blows the whistle, goes Adult Swim. People buy into stable coins for a while, take a break, take a breather, and then when they're ready, they will jump back in and jump back into a lot of these more volatile tokens. So Effect Chan said, in my opinion, the price of crypto is actually a scam. Yeah, I mean, there's so many. I kind of halfway agree with you on that. Yes, there are a lot of projects that sit there and pump and dump and inflate prices, and they garner a bunch of enthusiasm, and they're nothing more than Ponzi schemes in that way. And it takes a lot of work and research. That's one of the largest criticisms of cryptocurrency. When you're trying to explain it to a newbie, and like I was last night, the only thing that they hear is the mainstream media talking about how it's a Ponzi scheme, it's used by criminals and stuff like that, and that all the Bitcoin energy usage is another big thing that I hear. I just it takes work, and this day-to-day show that I'm doing here is my version of this work on that, to filter through all the fluff and all the crap and try to find like the really good stuff. And I believe that crypto is a Web 3.0 technology, and I've read an article. I'm going to go over an article here that talks about some things that Paul Krugman was saying. That the internet was nothing more than a fad, like the fax machine. And yeah, obviously not. But So, but anyway, so speaking of Ponzi schemes, I found this article here. Debunked Bitcoin as a Ponzi scheme. Hacker Noon's a great source for just interesting articles. There's a lot of tech-oriented stuff. It's not all about cryptocurrency stuff. I don't really come from a heavy tech background, and I don't come from a heavy finance background, so I find myself having to learn the very foundations of things, and I look back down to the very base foundation, because a lot of times you hear these interviews with a lot of these heavy crypto heads and these finance people and stuff like that, and they're throwing around terms like I should know it and like the rest of the world should know it. What people in these fields don't understand is that the rest of the world is listening, and it's not just some kind of academic financial journal or something, or some computer science journal. So they throw these terms around. But with crypto being the gateway, they don't realize that the rest of the world is listening to them with interest, as they're just throwing out their academic jargon in a lot of cases, or their industry jargon. I've been trying to take the time to learn all these terms and stuff, even down to the essence of exactly what a Ponzi scheme is, what securities and commodities are, the difference between token and coin, which I'll get to here in a second. So there's so many of these nuances that people just kind of throw around, what an ICO and a TGE is. ICO is initial coin offering, TGE is token generation event, So learning these acronyms have been kind of the first major hurdle to get through. It's kind of like learning a language. And I've learned Spanish a long time ago. I majored in Spanish, but part of how I learned Spanish, yes, by traveling down to Mexico a lot, but I just listened to Spanish radio all the time. I didn't understand jack squat at first, and the more I just kind of constantly listened to it, I'd be able to pick up a little bit more in bits and pieces and start to be able to piece together conversations. And the same thing with listening to crypto interviews. When I first started listening to crypto interviews in 2018, early 2018, I was like listening to Sergey Nazarov talking about Chainlink, and it sounded like a complete foreign language to me, like complete Greek, literally. And then I didn't even know what KYC was. Then it's starting to piece together more and more. Effect Chan says, the essence of crypto should be a reward for contribution, not a way of speculation. Absolutely. I believe in fundamentals. I believe in the fundamentals of projects. What does it do? And a lot of these projects, they're only in place for the purpose of speculation, and that is a red flag to me. They're very cultish, and you know which projects I'm talking about. And I'm like, well, what does it do? Well, if you put your money in, it plugs into this mechanism where it gathers interest, and then there's a fail proof, and but you're going to be rich, and I'll always run from those things. And I'm sure several of you know exactly some of the projects I'm talking about. I'm not going to mention names, but I like my projects to do something. What do they do? Do they, like Theta platform, does it allow users to share their bandwidth to earn tokens in exchange? Noia, that particular token helps deal with internet traffic issues. Chainlink is an oracle that brings real world data to the blockchain. There's a lot of tokens that do some really, really cool stuff, and that's the type of stuff I like to focus on. But anyway, so let's talk about Bitcoin here for a second. Actually, hold on. I did want to give you a quick update on the Theta protocol because obviously I'm broadcasting on Theta, so I'm a huge fan. Hey, Softwater, how you doing? Theta is coming out today on GitHub, July 25th, 2021, with a hard fork to 3.1.0. So in June 30th, they had the first 3.0 hard fork. So there's some more updates that are going to be happening with Theta, and the actual hard fork is on July 30th. So there's nothing you have to do with your Theta or T-Fuel tokens. But some of these updates are more efficient block proposal protocol, highly optimized blockchain database, so that'll be a little bit faster, faster snapshot import. So when you first launch a node, it won't take so much damn time if you're trying to do a Guardian node, because doing a Guardian node has always been kind of a pain in my ass, which is why I just run the Edge node. I mean, it's pretty easy, relatively speaking, but I mean, it's just like, I got enough crap running on my computer, so I just run the Edge node because the Edge node is light and simple. And then the biggest one that I think is support for Ethereum RPC API. So in your MetaMask, you can enter in new RPCs and do different types of chains, like the Matic chain, the Energy Web chain, XDAI RPC, and stuff like that, Binance Smart Chain, and you can integrate all that into your MetaMask wallet. Now you'll be able to do that with the Theta chain. I think that's pretty cool, and the cross-chain compatibility between Ethereum and Theta, which Theta and Ethereum are two of my favorite blockchains, and I'm very happy to see them get along better. So that's that news. Anyway, back to this. Okay, so debunking the immature myth about Bitcoin. So I got confronted with that little question. Well, isn't it? I don't know. I just hear it's like a Ponzi scheme. What is a Ponzi scheme, first of all? And there's this amazing podcast on Spotify that talks about the what is the name of that podcast? It gives the history of Charles Ponzi, and he has a fascinating story. He's like a completely poor immigrant, and in Boston, and builds his way up to becoming, basically the cock of the walk up there in the East Coast for the longest time and owns pretty much everything. And then he crashes and, in a way, returns back to his poor immigrant status near the end of his life. But it's an incredible story. But so Charles Ponzi scheme the Ponzi scheme named after its originator, Charles Ponzi. It's a fraudulent investing scam that generates returns for earlier investors with money taken from later investors. The most famous modern Ponzi scheme is the Madoff security with Bernie Madoff, kept running for about 40 years. Interestingly, Madoff was the former NASDAQ chairman and almost became the head of the U.S. Securities Exchange Commission. Yep, sounds about right. Does Bitcoin meet the definition of a Ponzi scheme? First, let's start with a definition of a Ponzi scheme. Ponzi scheme is an investment fraud that pays existing users with funds collected from new investors. Ponzi scheme organizers often promise to invest your money and generate high returns with little or no risk, but in many Ponzi schemes, the fraudsters do not invest the money. Instead, they use it to pay those who invested earlier and may keep some from themselves. So they rob Peter to pay Paul, in short. With little or no legitimate earnings, Ponzi schemes require a constant flow of new money to survive. When it becomes hard to recruit new investors or when large numbers of investors cash out, these schemes tend to collapse. So Charles Ponzi was selling some international postage stamps, I guess. And he was claiming that they were valuable and that I don't know what the value of international postage stamps were in that day, but people were investing in them. Trying to speculate on their increasing value, and he was there, but he never actually owned the stamps. So he claimed rights to these stamps, but never actually owned, and was always getting new people to invest in them. And then what people supposedly the equity that people would have earned by owning these stamps, he was paying the people who were the earlier investors with the money from the new investors. So no stamps were ever actually owned. So that sounds pretty familiar to some crypto projects. According to the SEC, Ponzi schemes must fulfill the following criteria. Let's tackle all their red flags one by one. Well, they're high returns with little or no risk. The creator of Bitcoin, Satoshi Nakamoto, never promised any investment returns, or let alone a high consistent investment returns. In fact, Bitcoin is exceptionally high volatility and high risk profile with frequent 50% drawdowns, as you just noticed the past few weeks here. So a lot of people who are new to the crypto space and bought in during March and April, and they're just flying high. They're just like sucking wind, and it's been funny to see because this is now not my first major crypto drawdown. So I'm just sitting back, looking at it, being like, anyway, overly consistent returns. Over many years, Bitcoin may generate returns, sure, and it has for a lot of people. Its returns are only consistent over 4-year windows. In the short term, Bitcoin has had negative or flat growth. And like I said, this has happened just recently. In the short term, anybody that jumped into the crypto market and threw everything that they had at Bitcoin or Ethereum or whatever in April is like seriously, eating a bunch of poop right now. But it's starting to come back for a lot of people, as you can see on CoinGecko. Unregistered investment. Bitcoin is being deemed by the U.S. SEC, CFTC, and IRS as a commodity and property. So Bitcoin is treated as a commodity, and I'll get into the difference between commodities and securities here in a little bit. Unlicensed sellers. Most crypto exchanges are registered and compliant with that company's regulations. So that's why we have KYC, which stands for Know Your Customer, and AML, anti-money laundering guidelines. So many global banks, asset managers, and commodity exchanges offer exposure to Bitcoin. Was it Grayscale has the digital assets? BlackRock is now investing in that. Goldman Sachs is investing in Bitcoin. JP Morgan, the CEO of Chase Bank, is now providing Bitcoin services. Bank of America is going to be providing Bitcoin services. So this is all developing, and it's things are changing, folks. And secretive and complex strategies. Bitcoin works on precisely the opposite set of principles. It's open source, and anyone can see it at any time. It's a distributed piece of open software that requires majority consensus to change. Every line of code is known, and no central authority can change it. See that white paper right up there, or maybe you don't. That shows that everything in the Bitcoin code is completely open source. Okay. So issues with paperwork. Bitcoin code can be monitored and reviewed by anyone, and exactly what I was talking about. So you can see every transaction. You might not see who's doing it, but now with chain analysis, you pretty much can. Except now that they have this Taproot upgrade, it's actually implementing some type of ring signature technology, which would provide a little more anonymity, which I think is great. But that's a whole other episode. Okay, anyway, difficulty receiving payments is another flag for Ponzi schemes. Bitcoin is now almost $1 trillion asset and is highly liquid. It can be safely stored with a licensed custodian, transferred at speed of light, and converted at any time to fiat other cryptocurrencies through exchanges. Okay, anyway, so who claims that Bitcoin is a Ponzi scheme? This is who I was talking about, Paul Krugman, the crypto skeptic. And I'm sure who's the other? Peter Schiff, I'm sure that dude, So in an interview for New York Times, he compared cryptocurrencies to a Ponzi scheme. He never actually published proof for his claim. Krugman is best known for predicting that by 2005, the internet's effect on economy will not be greater than the fax machines. To put it another way, the same skeptic who told us that internet was economically unimportant now says the same about crypto. And you find this with a lot of these people. Jamie Dimon, of J.P. Morgan, is said that crypto. What did it say? I can't remember what he said, but he just basically said that Bitcoin is complete trash. And then now he's that was just in 2018, and then now he's saying that they're basically going to be orienting services around Bitcoin and allowing all the Bitcoin services to be available. So, and then of course Dave Portnoy, who you know as Lettuce Hands, he jumped in and bought $25,000 worth of Chainlink, I believe, and then it crashed. As Chainlink tends to do, it goes in these weird spikes, and blamed it all on us, saying that we're all part of a huge Ponzi scheme. He was just bitter and salty. Okay, so because the narrow Ponzi scheme definition doesn't apply to Bitcoin, some people have used a broader definition. They assert that Bitcoin acts in accordance with the greater fool theory. This theory argues that prices go up because people can sell overpriced assets to a greater fool. Although this claim may be partially valid during the Bitcoin bull markets, it's equally true about any commodity. It's important to realize Bitcoin is not a currency, it's a commodity, and like any commodity, it produces no cash flows and is only worth what someone else will pay for it or you trade for it. In this case, Bitcoin principally serves as monetary energy, and if you listen to Robert Breedlove, he really describes exactly what monetary energy is, and he does an amazing job at it. And its utility is entirely about storing and transmitting value without a centralized party, aka banks, and this makes gold its closest comparison. For example, Bitcoin's creator Satoshi Nakamoto said, Bitcoins have no dividend or potential future dividend, therefore it is not like a stock, more like a collectible or commodity. Another key point to realize is that the commodity status doesn't make an asset a Ponzi scheme or a greater fool theory type of investment, because by similar logic, gold follows under that exact same definition. The vast majority of gold's usage is not for industry, it's for storing and showcasing wealth. It produces no cash flows and is only worth what someone else will pay for it. So, they keep on going on down here on some more stuff, but I did want to take a quick look about commodities versus securities, because during the entire XRP scandal, I had the hardest time trying to figure out exactly what commodities and securities are, and why they were fighting over it, and what difference does it make? Who cares? That's easy for me to say, but hold on. So, the best way to determine whether something is a commodity or security is using the Howey test. And the Howey test is just a financial test to figure out what category something it is. Okay, so here's one. Is there an investment of money with the expectation of future profits? 2, is the investment of money in a common enterprise? And then 3, do any profits come from the efforts of a promoter or third party? In layman's terms, a security should produce a return to a common enterprise in the form of a percentage of potential profit and the common enterprise generates. The owner of part of the enterprise's capital structure remains the same regardless of whether no profit is made. This isn't happening with a vast majority of crypto utility tokens. Any expectations for returns in the future is mostly generated by a scarcity of supply and demand. Some of these examples, these assets include numismatic coins, collectibles, rare art, and tickets for concerts. None of these properties or assets are regarded as securities. So commodities are assets, property, or goods that can be bought or sold on an exchange. Some typical examples of this are raw materials or agricultural products. Like securities, commodities don't generate a return from a common enterprise. Instead, they're goods or property that get grown or mined, where their value depends on the supply and demand of the market. Okay, so if you use the Howey test, and the crypto asset is very similar to the traits of a cryptocurrency or utility token, it can be classified as a commodity. However, the issue lies in how a crypto asset project starts, playing a greater emphasis on the how rather than the what. For instance, if a crypto asset comes into existence via an ICO, an initial coin offering, or a token generated event, the TGE, where investors are offered a token in exchange for money up front for a project that doesn't exist yet, and they expect to make a return, then things are different. In theory, anything like this would most likely be classified as a security. And in 2017, what was happening, and when everybody was buying Lambos and condos and this and that, and just like completely going off the chain with all these new ICO events, and just random schmoes were just generating millions of dollars by creating some Yahoo coin out of nowhere, setting up an ICO event, doing an amazing PowerPoint presentation to a drunk audience, and then generating hundreds of thousands and millions of dollars for this, and then afterwards completely disappearing, or the token just completely evaporates and becomes vaporware. And then a lot of this people started catching on to a lot of this and realizing it, and a lot of these projects completely crashed, and they had the 2017 crypto crash. And then after that, crypto had a completely tarnished reputation, and everybody's like, nah, forget this, I'm out. And then 2018 was a very depressing year for a lot of crypto heads, and it was the doldrums. Interestingly enough, 2018, right after the 2017 crypto crash, was when I got into crypto. So you can truly say, no, that I got in it for the tech. But I didn't really understand what was going on. All I knew was I was just kind of late to the party after all the beer cans were left sitting around, the empty beer cans, and I was just kind of trying to figure out what happened. And by the time I started figuring out exactly what happened, then things started picking up again, and I was like, oh, okay, so I jumped into a bad place, didn't I? So, but either way, whatever. So the difference between a commodity and a security, if something is deemed a commodity, it doesn't necessarily have as many regulations and is vulnerable to hardcore regulation and taxation and stuff like that in the same way that a security is. So you want your coin, I think, to be a commodity, if I'm correct. Correct me if I'm wrong along this way too, because I'm learning all this stuff as I go. So anyway, as an investor in a lot of these projects, you really want to take a look at this, because you don't want to invest pretty heavily in a project and then suddenly it get under major fire for becoming a security, and then you lose everything because the price of the coin just completely plummets. So you have to ask yourself, is it a coin or a token? If it's a coin, is it mineable or decentralized? Is it functioning in production? Was there an ICO or TGE? Was it offered in a public or private sale? If it's public, was a KYC AML conducted? Oh man, I get some Chinese bots going into my Telegram here. So one of the least risky crypto asset is a mineable coin that runs on a functioning decentralized blockchain network. A coin is usually less risky than a token because it's running on its own blockchain. If a coin is mineable, the economics differ from those who bought one in an ICO or a TGE, as miners receive coins for work. This was confirmed when the SEC publicly announced that Bitcoin is not a security. If a project is decentralized, it can be argued that it is not a common enterprise, therefore it is less risky. In contrast, the riskiest coin would be pre-mined and centralized. So look out for pre-mined coins and centralized tokens. There's a high probability that it would be classified as a security. So In the case of it being a token instead of a coin, ask yourself, is its network functioning? If the answer is yes, it's less risky. So what does it do here? In like an office space when they're interviewing Ron Livingston or Michael Bolton or something, they're like, what exactly do you do here? No, they're interviewing Milton. Anyway, in the case of it being a token, okay, so ask yourself, is its network functioning? Yes. The next consideration is whether the crypto asset was born out of an ICO or token generation event, and whether there was a public sale or not. ICO, TGE, and public sales all create more risk, especially if no KYC AML was completed. And when I first started out in crypto, I was just like, who cares? Let them raise some money. But then I was like, once I learned about vaporware and all that stuff. Okay. Anyway, so let's take a quick look. Coinbase ad. Coin versus token, what's the difference? Digital coins are generally used in the same way as real life coin is, as money. So this is a coin. Coins are, okay, so Effect Chan says Ponzi schemes often appear in the form of ICOs and IPOs. Yes, because they're raising money and trying to create hype around the product, and a lot of hysteria and stuff like that. Many scammers make a fortune in this way. Yes. So thank you. So Andy Panda, what's up, Andy Panda? I've seen you on here before as well. So digital coins are generally used in the same way as real life coin is as money. So now we're on to coins versus tokens. Okay, so coins are generally based on the actual base blockchain. Bitcoin is a coin, Ethereum is a coin, Neo is a coin, Monero is a coin. It is based on the blockchain. A token is, for instance, an ERC20 token. Chainlink is a token. Unibright token is a token. Bancor Network is a token. It sits on top of another blockchain. Okay, you can think of coins like Bitcoin, Litecoin, and Monero just like the coins in your wallet or piggy bank. They often don't serve any other purpose other than to be used as money. These cash-only coins are used to transfer money, store value, unit of account. So let's use Bitcoin as an example. Bitcoin can be used to pay for goods and services all over the internet and in real world, in the meat space. You can store it for a long period of time and nothing happens to it, and then you can swap it for something of equal or greater value later. And then the things that you can buy can be priced in Bitcoin, including pizzas. The famous pizza that was bought for $2 Bitcoin. I don't know how many Bitcoin, but it's worth an assload of money now. Other than these monetary uses, there's no other use for Bitcoin. It can't be staked to earn more Bitcoin, and it doesn't need to be used to operate certain applications. It is used as money, and that's all. Then they get into some subtleties, like Ethereum and Neo and Dash can have some other subtle uses, but those are still considered coins, and I don't really want to go there yet. But token versus coins, examples of coins. All the largest market cap digital assets are defined as coins today. However, not all coins have a large market cap. So Bitcoin, Bitcoin Cash, Litecoin, Ethereum, these are all coins and versus tokens. So tokens often get called digital coins. However, this isn't correct. There's a major difference. Tokens are created on existing blockchains. In fact, thanks to the creation and facilitation of smart contracts, the most common blockchain token platforms is Ethereum. Tokens that are built on Ethereum platform are known as ERC20 tokens. But you can build on tokens on Neo, Wave, Lisk, Stratus, and a few others as well. Now Theta platform. So it takes surprisingly little technical ability to actually generate a token. I've created a token on the Theta blockchain. I created my EKA Eureka token. If you want me to send you some Eureka token, I can send you some Eureka token. Just send me your Theta address, and I will send you some Eureka token. It's absolutely worth nothing. But hey, you'll own some Eureka token to do jack squat with. So, for example, if a token is being generated on Ethereum, the creator will need to spend some Ether to get to the network's the miner's value to validate the token transaction. So, for instance, Uniswap. If you want to swap on Uniswap, or if you want to send one token to another person's wallet or use it in any type of protocol, it takes Ethereum gas to do so. So that is also what makes a token rather than just the base coin. So this is the same as how coin transactions need fees to be paid for those securing the network. So most tokens exist to be used with decentralized applications or dApps. For instance, I mentioned Unibright a second ago. You will need the Unibright token in order to use that Unibright smart contract plug and play type of service, the graphical user interface. So yeah, so when developers are creating their token, they can decide how many units they want to make and where they want these tokens to be sent when they will be created. Many of the native cryptocurrency on the blockchain, they're creating the token at this point. Once created, tokens are often used to activate features of the application they are designed for, like I just mentioned with Unibright. Some tokens are created for a whole different kind of purpose to represent a physical thing. So let's say you wanted to sell your house using a smart contract. You can't physically put your house in the smart contract, can you? No. So instead, you use a token that represents your house. Now that's tokenized assets. And a lot of people are trying to do this with real estate. They're trying to say, you can own a piece of the Empire State Building. That's like one of the biggest analogies I hear, to kind of sensationalize it. But, they would split up a piece of real estate into tokens and you would own a piece of that. I don't really know how well that model really pans out, but I do believe seeing somewhere that Uniswap has had to take off a lot of these tokens off of there that represent real world assets like gold and stocks and stuff like that in order to get out of these sticky waters with the SEC regulations based on securities and tokenized assets and stuff like that. So you got to kind of watch out for stuff like that in this space where a lot of this stuff really isn't concretely defined. So anyway, since the developer of a dApp and token doesn't have to create their own blockchain, it saves them time and resources. They can use the features of cryptocurrency with their application while benefiting from the security of a native blockchain. That's exactly what the Komodo blockchain does. Now, it originally used the Bitcoin blockchain, but now it uses the Litecoin blockchain to kind of notarize and do a delayed proof of work. And it uses the security of these stronger, more well-established blockchains so people can develop new blockchains, because young blockchains, if they created their own blockchain and coin instead of a dApp and a token, they would need to find miners to verify their transactions too. And if you don't have a large miner network and node network set up when you're starting up a new blockchain, then you're very vulnerable to 51% attacks. And it's very dangerous for new blockchains to start out. So that's one thing that Komodo blockchain does. It has that delayed proof of work that uses the security of parent blockchains to be able to create new blockchains underneath of it. So it takes a lot of miners to create a strong blockchain that can't be attacked. It makes much more sense for many computers to work on one shared blockchain that several applications can run on, rather than there being thousands of weak, mostly centralized blockchains. Anyway, so yeah, it goes on, and I think I've kind of covered most of the gamut, but let's take a real quick look. Token versus coin, security token, equity token, or utility token. Finally, in the token definition, let's look at a few different types of tokens. In February 2018, Swiss financial regulators FINMA published guidelines that defined what security or asset, utility, or payment tokens are. This was to help them work out how to treat different tokens when considering their legality. So you have to always consider this stuff when you're trying to jump into a new project. Security tokens. Most tokens issued by ICOs are security tokens. The person buying them is investing their money in the ICO with the expectation of profit. Under Swiss law, these are treated in the same way as traditional securities. So equity tokens, if it represents the stock or equity in the company that issues it, it's an equity token. Utility tokens, also called application tokens, are used to provide people with access to a product or services. And then payment tokens have no other purpose than to pay for goods and services. When they classified the types of tokens currently available, FINMA was careful to point out that each token could fall into more than one category. So anyway, that stuff is just interesting. I'm not sure what the takeaway from all this is. It's just, I guess the takeaway is to know that there's a lot of very nuanced categories and complications and things like that whenever you are investing into cryptocurrency, and to not just ape in. Try to educate yourself on some of the regulations, the difference between commodities and securities, difference between tokens and coins. It's very important, because you could find yourself in some very hot water, and And that's kind of the beauty now of some of these DeFi mullet type of services where they have, banking structure facade in the front, and you earn your 4% like in compound treasury, but in the back, they're back there using DeFi services to create and generate yield. It's a safe way to go into it. You don't have to hold a wallet or anything like that. You just give them your routing and bank account information, or something like the BED index. That just came out with a bankless DAO, and that's using, you can jump in kind of a little bundle of funds that is like 33.3% to 100% of a Ethereum, Bitcoin, and DeFi index, and you can invest in that, and that's kind of a safe way to do things. If you're just starting out and trying to do research, but you want to hurry up and get involved, those are things you can invest in rather than trying to find some weird micro cap token. So anyway, hey, what's up, Valery Merev? It's been a minute. I'm glad to see you back on. I'm actually about to jump back off. But people, I am now giving POAPs, which is proof of attendance badges, and they're NFT badges to prove that you have watched the show on the day of release, to Theta watchers and YouTube and whatever else. As long as you DM me on Twitter, or you can hit me up on my email right there, eurekastreetcryptohub@gmail.com, or you can hit me up in my Telegram or whatever. Shoot me something and just say POAP, please, and I will send you the NFT POAP. I'm only minted at 75 of them for today. I started it as POAP number 3 now, and each POAP has a different design. But they've been going like wildfire, man. Like my phone just blows up after I sign off, and I put up the notice, and everybody's saying POAP, please, and then they send me a screenshot showing that they watched it or something, or just say you saw it on Theta too. I'm giving these out. Maybe they'll be worth something one day. I don't know. I don't know. It's like getting an NFT for watching episodes of Mr. Rogers. I don't know. Mr. Rogers of crypto? Maybe that's what I aspire to be. I don't know. Yeah, you'll get a POAP for it. Let me see if I can find the design and show you real quick. Episodes, graphics, POAP. I was having trouble like pulling up. So, open with. So I'll try this program and see what happens. I've created the POAPs. I have 75 of them. But for some reason, this file that I made doesn't want to open with some of my applications. All right, so whatever. You'll see it. You'll see it when you see it. I'll post it up on Twitter, and you'll be able to take a look at it. But people like it. So, okay, yes, Effect Chen, I'll give you the POAP for sure. There's only 75 of them, and they go like hotcakes, man. POAP, get your POAP. Step right up, get your POAP. All right, so that being said, I will be signing off now. I'm going to go to the skate park and have a little homie date with my skateboard and some skate homies. And hopefully I don't beat myself up too bad. Then I'm going to try to make it back in time to make all my girls breakfast and stuff like that, because that's what I do on weekend. I am the breakfast man. And then after that, I will get around to sorting out who were the first people to ask for POAPs and issue them out accordingly. So, yes. All right. You guys have a good weekend or Sunday, and I will talk to you all tomorrow. Okay? Later.